When we're talking about volatility for the equity market, it's really measured by the index called the VIX, VIX. And really what that is a measure of the volatility of the options on the S&P 500. The calls and puts, the volatility measure. In normal times, the VIX probably will trade, say, between 15 and 25 as an absolute measure. Those would be normal. The lower VIX usually refers to lower volatility, lower risk that the stock market's going to tumble or spike up. However, recently we had the VIX Index climb all the way to 48. This was right before, I want to say April 8th, which was the day before the president announced he was going to pause the tariffs. That was on April 9th, and the market shot up. The S&P shot up like 9% that day. But historically, when the VIX is above 40, this is according to Barron's, 97% of the time, the equity market will be positive in the next 12 months. So if you believe in that statistic, we were at, as I said, 48% in April. And we're currently somewhere, I think, in 23 or 24 on the VIX. So we're basically half of where we were on April 8th. So that's usually a good omen for the market. And since the pause of the tariffs on April 9th, the market has done substantially better. There's been a lot fewer people criticizing the president's tariff policies since the market's been much better behaved. And now he's starting to get more credit, like maybe he knows what he's doing after all, kind of commentary. So we'll see what happens with all that. But I do think volatility is something we obviously want to keep an eye on. Volatility makes people nervous, makes the stock market nervous. But if you believe in the VIX Index now, we're back to normal times. So the outlook should be improved. John Dunleavy, Monorail.